that time, almost 60% of the value in the large cap space has been eroded in the market, right? I mean, it is not a great feeling when we start seeing losses. But at the same time, a different perspective would be when you really look at things from a much longer horizon, right? From, if you see from 2004 till 2022, yes, there is 2008 and there is 2022, 2020. All those blips are just part of the history. In general, if you see, there is an upward trend in the market. So all I want to say is, I'm sure all of you are aware. I'm sure that's what the team would be really giving you those assurance. But just from an outsider perspective, I think these kind of corrections are needed for us to go back and then revisit our drawing board once in a while, right? So all of us want great returns in a portfolio. And it's very rarely we would love to see losses in the portfolio. We always want to really manage that risk and return really well. So what I want to ask, or what I think we should understand today, is what are some of the key drivers which drives the portfolio returns, right? Other than just saying, okay, just be part of that one best performing fund or a one best performing stock which gave multi-bagger returns, right? That's like a dream come true. All your money being part of one scheme or one stock which did exceptionally well. But if you just leave that dream scenario for an ideal scenario or in a realistic world, for a mutual fund portfolio or an investment portfolio, what are some of the key drivers and returns? So I would probably put them into three categories. That is asset allocation, fund selection, and systematic investments. Okay, these are the three broad strategies we could adopt to have some kind of a decent, predictable returns coming in our way, right? So when we talk about asset allocation, we all know there are plethora of investment options available or multiple investment options available. We can categorize all of them and put them into four broad categories: equity, gold, real estate, and fixed income. So when we say fixed income, right from fixed deposits to bonds, public provident fund, employee provident fund, anywhere you get the predefined return. So those are broadly four asset classes which are available in front of us. But if life was so simple, I think it would have been easy, right? I mean, we all say that, okay, equity is the best or gold is better, but life is not that simple, right? When we look at every asset class, there are multiple subcategories, right? When you look at equity, there is domestic equity or international equity. Within domestic equity, large cap, mid cap, small cap, or taking exposure to specific sector or a theme, right? Multiple options coming in there. Then when you look at fixed income, would you look at investing in a debt mutual fund versus a fixed deposit or a government bond directly? How would you really manage your portfolio? Gold or physical gold or a gold ETF. Coming to real estate, I'm sure real estate is probably very tempting, but at the same time can be confusing also. Residential property versus a commercial property, or a REIT kind of an investment option or financial way of investing into real estate. There are these multiple options available. But the question is, what's your favorite choice? Probably take a second or two. What's your favorite choice out of these four options which are in front of you? I've added cash also. That's also fifth option. But broadly, we'll put them into four broad asset classes: equity, debt, gold, real estate. Normally, we all have our favorites, right? So let me give you an analogy of having favorites. Imagine you're building a nice T20 cricket team, and then you are the captain and you're supposed to build a team. Just because you love batting, if you picked up 11 batsmen in your team, what are the chances of you winning that particular game? Very soon, right?
Sorry to interrupt. You're moving slides?
I'm moving slides here.
We're not able to see that. Maybe you can put it in a presentation mode.
No, I've done that. Yeah. Can you see this now?
Yes, we can see now. So try to move. Yeah. We can, yes. Now it's working.
Yeah. So coming back to the story of 11 batsmen in your team, even if all 11 of them are best possible batsmen, the chance of you winning the match would be very unlikely, right? Because I'm sure there's no brainer there. You need bowlers, you need wicket keeper, you need fielders. I mean, it's a 11-member team. Even within batting, you need specialists. You need someone to finish the match, but you also need someone to start the innings. So the specialist skill sets, what is required is totally different. So just because you like some investment option, making that as a favorite, I think is probably one of the biggest emotional mistake what we end up making in the journey of, what we would end up making in the, like let's say in the journey of wealth management or wealth creation. So what are those asset classes, and how do you really evaluate them is a very big differentiating point. What we really ideally start with is each and every investment option. What are the pros and cons? That will really help you in totally understanding how should you build the process. We all know equity is a great investment option for long-term wealth creation, right? You will always have these ups and downs. What we are seeing right now, 2022 or early bit of 2020, the corrections what we saw is a classic example of equity not doing so well in given times. But at the same time, you also need to have patience to say that I will make money in the long run. Is there a way where we can reduce this risk of equity and then say, okay, markets are coming down, but still my overall portfolio is not as bad as probably what market is looking? So that is possible with what we call it as asset allocation. I'm sure all of you are aware. So how is asset allocation possible? The first way is adding gold to equity. Why gold? I'm sure all of us are aware. Every time market starts going down or economy gets into a bad shape, the investors or the markets run towards gold. So if you really look at right from 2008 almost till 2022, the gold and equity markets, if you see the blue line is gold and the orange line, what you see is Nifty, there is equity market. Almost you can see that negative correlation. 2020, gold gave phenomenal returns, especially when equity markets were down. And then subsequently, when equity markets started going up, gold prices started coming down. So what does it essentially indicate is, in very simple terms, to overall equity investments, whatever you have, adding a bit of gold would always help you in reducing the risk. That's something which is very important. But let's look at when we talk about investing in gold. I'm sure all of you are familiar that consider investing in financial form. It could be gold mutual fund schemes or gold ETFs, etc. More liquid, like let's say you can buy and sell it at uniform prices. I'm sure all of you know the benefits of it. So adding gold definitely helps, like let's say reducing the risk. The second and the another asset class which would really help in balancing out, or what we're talking about, the asset allocation itself, is debt. In general, debt is considered to be very old method of investing. Some people say, "Arey, it's very old. I don't think equity is the in thing." Right? I agree. Equity gives that excitement. Equity gives that great returns possible. Right? Looking at 2020, 21, there's no doubts about it. But especially in times like this, okay, when you see losses in your portfolio, if on the other side, if there is some portion of your portfolio or some component of your portfolio giving you even 6-7% or 7-8% return, is not a bad deal. The chart, what you see here, is an example of, or the performance of equity funds. I've taken here the example of flexi cap funds. How is that they would have performed year on year, 2013 to 2019-20? How would have performed year on year? What would have been their returns? At the same time, the 100 rupees what you have, out of that 50% allocation given to floating rate funds versus another 50% allocation to short duration funds. So that means you have built a portfolio of floating rate and short duration funds. That's the green line what you see here. Almost every year, on average, the consistent return in the range of 6.5 to 8.25% kind of return what you've given. Even during the years where equity markets are down or like given you 1% or 5% or minus 6-7%, that's the kind of return what in some years equity markets would have given. Adding some bit of debt to your overall portfolio brings in that stability to the portfolio, right? So when you really look at asset classes, essentially what ideally you should be doing is, okay, equity is fine, fantastic, but can we really reduce the risk of equity is ideally what you should be looking at. So that is what we call it as asset allocation. So when we say asset allocation, you're mixing two asset classes and then building a portfolio or making a portfolio out of it. Okay. For example, equity and crypto assets. Please don't take crypto assets as my recommendation. I'm just giving you as a sake of example. If you see crypto assets and equity, at least in the last 2 years or 2.5 years or so, they're completely positively correlated. Equity markets are going down, so is crypto assets. So if you have to add both and then create a portfolio out of it, that means you're essentially increasing the risk of your portfolio. So how should be the mix? The ideal mix should be that when you're mixing two asset classes, they should be negatively correlated. Okay, that's the combination ideally you should be looking for. We have just discussed equity and gold, equity and debt kind of a combination gives you negative correlation. How will that benefit? How will that help us? Okay. So what I've done is I've taken a small example here. If you have 100 rupees and if you have invested in say 3 flexi cap funds, please read it as flexi cap fund, not as multi cap fund, and all 3 of them you've given the equal weightage, say 33 rupees, 33 rupees, 33 rupees. How your all equity portfolio would have performed versus out of 100 rupees, 70 rupees you are investing in equity and 30 rupees you are investing in gold, how that particular combination would have worked. I'll call this as asset allocation line, right? Combination of same 3 flexi cap funds in 70% and 30% in gold. The chart would have looked like this. Starting from the calendar year 2007 till 2020, your returns performance would have looked like this. When I say return performance, assuming had I invested 100 rupees at the beginning of 2007, how that 100 rupees would have moved. The light blue line is asset allocation line and the dark blue line is all equity line. So at the end result, 100 rupee invested after 13 years, the asset allocation is 675 rupees, whereas all equity 607 rupees. But that is not the outcome or the takeaway what I want you to look at. Look at the markings, what you see on the screen now. Especially in years where markets are coming down, your asset allocation portfolio losses are lower compared to all equity portfolio. Okay, so before 2008, 164 rupees was all equity value. It is straight down to 95. Look at the amount of loss you would have seen in your portfolio versus 149 coming down to 116, despite of having 70% exposure to equity. Look at 2011 market correction or 2018 when markets went down. In all these 3 years, the losses in your asset allocation portfolio is much lower compared to all equity portfolio. So the overall risk, when we say risk, we are talking about volatility. The overall volatility goes down. That is very important. So some of the alternate funds which are available, there are quant-based funds. Basically, there is very less or little intervention from the fund manager. There are certain set quality parameters based on that. The stocks are selected or moved out of the portfolio. So there are such funds available. Or there are multi-asset funds which are available in the market these days. So when we say multi-asset funds, as the name suggests, like it gives you a combination of equity, debt, gold, and sometimes international investments as well in the portfolio, right? So these are some of the options which are available. So what we just looked at is the asset allocation. That's the first parameter. The second parameter is fund selection, right? I think when markets are doing well, I personally think selecting a fund is a lot easier, right? I mean, you pick up anything, it's looking good, you see great returns in general, okay? So how do we do the fund selection process? Very simple. Mostly you ask anybody today in the last 1 or 2 years would have started the process of investing. All we do is we just go to Google and search what are the best performing mutual funds, best performing equity funds, or for the best performing fund for 2020, 21, whatever year you want to put it. That's how we generally end up searching the funds and then give up the answer, right? Whatever is the outcome in the Google search, we go by that, right? I mean, there are a lot of these behavioral biases, what we get to see. Whatever first piece of information we get to see, we tend to react on it. Had you looked at the performance of 2021 and had you invested in based on that performance, it would have been totally different in terms of experience what you would have seen today, right? Because 2021, small caps did exceptionally well and outperformed the large cap by a big margin, right? So What generally indicates is, if you really start searching based on just last 1 year performance, the results what you get may be biased. Okay, and there's always that notion that small caps give you better returns than large cap. I agree, small caps give at times gives you better returns than large cap, but is it just the returns what you should be looking at, or should you be looking at anything more than that? So what I've done is I've taken the performance of Sensex, that is large cap, BSE 500, that is combination of large, mid, small stocks, BSE mid cap index, and BSE small cap index. If you look at performance of all these four indices from the calendar year 2006 to 2020, what you see on the first row is the CAGR, that is annualized returns. But had we done the same exercise by the end of 2021, mid and small cap returns would have been much higher. I totally agree with that. I am not saying all the times mid and small cap returns will be lower than large cap. I am not saying that. But what is that you should be focusing is on the next row, that is risk involved in that particular investment, that is standard deviation. So let's not get into technical. The risk number should always be lower, isn't it? If you look at the risk involved for large cap as a category, that is about 31%, versus for small cap, it is almost 52%. That means this in number is telling you how much your return can deviate from the average. So imagine 52% deviation plus 52 minus 52. Imagine the amount of volatility you should be willing or you should be open to seeing in your portfolio if you had only small cap or mid cap stocks, right? So that essentially mean when markets are going down, it is always large cap which tends to perform better compared to mid and small cap, right? So one is the bias towards mid cap and small cap, and the next bias is towards sectoral funds. Why I'm saying that? Because sectoral investments, I remember way back in 2007, the euphoria in the market was infrastructure theme, right? Almost every fund house had come out with their own infrastructure funds. People went frenzy. Even first time investors invested in infrastructure funds. Nothing wrong with them. Indian infrastructure story is yet to unfold, and all that story is still intact. There was a particular fund. The NAV of that fund was 60 rupees on January 2008. And if you see, by the end of 2008, it was down to 22 rupees, right? So imagine the amount of losses you would have seen in the portfolio. And for this particular fund to come back to that 60 rupees, it happened in 2014. That means it almost took 6 to 7 years for it to come back to its principal value. Why I'm saying that is specifically because whenever, at least in family gatherings, and I'm not into advisory, so I don't really get to meet a lot of clients in family gatherings or in social circles. People say IT sector is phenomenal. I think let's buy IT. That's what many people started their investment with last year. Again, I'm not giving you a view that IT sector is good or IT sector is bad, but please understand every sector, every theme is also cycle based. That means it will perform well only in a given economic cycle. So if you look at some of the best performing sectors out of 18 sector indices, what we have in Bombay Stock Exchange, from 2006 to 2020, the CAGR, if you leave Sensex out of it, because if we are comparing this with Sensex, only about 7 sectors have given returns better than Sensex. That means all other sectors have done or given returns much lower than Sensex. So that means if you look at sectors like metal which did exceptionally well till 2021, second half, or even to some part of 2022, metal did very well. But from 2006 to 2020, the CAGR was only 3%. So just because you believe that equity is good for long term, it reduces risk, that theory will not work for long term, right? That theory might not work for sectoral play. So that is why it's very important for us to understand sectoral investments can be very risky, can be cyclical. Sometimes when it does well, we invest and then it goes down. It will take years together for it to come back. So that is why it is very important for us to build the right kind of portfolio of funds, right? What are the right portfolio of funds? If you have 100 rupees which you have allocated for equity, you can divide them into two parts: core and satellite portfolio. Core portfolio is your all season portfolio. You can invest in them anytime, and majority of your money should get into this particular core portfolio all season. Satellite portfolio is where it is completely seasonal. It keeps on changing based on seasons, market dynamics, market condition. So core portfolio gives you stability, lower risk, again lower returns. Satellite portfolio, high volatility, but it can add to your overall portfolio returns. That's satellite portfolio. So what are some of the kind of funds which could be part of core portfolio? Large cap fund, mid cap fund, flexi cap, multi cap, tax saver. These 5-6 funds could be funds what I call them as all season funds. That means you can invest in them any time. So there is absolutely no issues there or no problems there. Okay, that's core portfolio. So many of you would be thinking, if it is so easy, okay, if it is just about picking up good large cap fund and a good mid cap, good flexi cap and so on, why can't I do it myself? Okay, why can't I select funds myself? I'm sure that's one question which generally runs into many people's head, because there's always that like conflict, right? I mean, if I can do it by myself, why should I go through someone else? But remember, if returns was the only factor, then every one of us would have been great at selecting the right fund. What's more important is, if a fund has given you return for last 1 year, is it just 1 year what you should be looking at? Or should you be looking at in the last 5 or 7 or 10 years, how consistent the fund has been, right? So that's also which is very important. What is the risk involved in the fund? So it's not only about generating great returns, it's also about getting, understanding how much risk involved. I remember some of the funds which were good funds of 2007, great funds of 2007, were nowhere in the picture or somewhere at the bottom in 2008 and 9. And it took years together for them to come back, because the risk involved in some of those funds was significantly higher. And we also look at some other ratios like Sharpe ratio, which is risk adjusted return. So there are a lot of factors which goes in before we really, like let's say a portfolio of funds is actually selected. So ideally, even though as simple as it sounds, there's a lot of science behind it, especially in the fund selection. So why is it important? I'm just going to show you a small, like let's say chart here. I know the font size is small. I tried really fitting in all the possible funds. Okay. The table, what you see here is the performance of large cap funds on a yearly calendar year basis, 2012 to 2021. Can you name one fund which has been consistently number one all through, or consistently in top 3 all through? It's not there, right? I mean, if you see any fund, like let's say SBI Blue Chip, it was number 3, number 11, number 4, number 1, again number 11, number 15, number 22. Out of 25, 26 funds, there are also times this particular fund is at the bottom. There are times it is at the middle. There are times it is at the top. So one of the biggest mistake what people do when they invest in their own funds, I mean, in the sense, do it yourself kind of portfolio, look at this year, that is 2022, invest in top 3 funds of last year. So most likely, if you keep on doing it every year, like let's say 2013, you invest in best funds of 2012. 14, you invest in best funds of 13. If you just do that, the amount of wealth erosion what you would have seen would have been much higher compared to sticking to some good funds and then probably track them once in 2 or 3 years or so, and then really look at handling your portfolio that way. So fund selection is very, very important, like let's say function or a factor in your overall journey, right? So I've just taken a small example, right? If you're done 9,000 rupee SIP in these 3 funds, these are 3 actual funds what I've taken: one large cap fund, one mid cap fund, one multi cap fund. The one thing what we need to understand is not all the funds we pick are great funds. Some turns out to be great, some turns out to be average, some turns out to be like let's say below average. But if you were to look at them individually, how it would be, if you were to look at them in a portfolio wise, how will it look? I've taken a below average large cap fund, 9,000 rupee SIP for 270 months. Okay, would have given you 1.78 crores at a CAGR of 15%. Standalone 15% CAGR is phenomenal. But when you do relative comparison, it looks different. I've taken a mid cap fund which is done well, 9,000 rupee SIP, 271 months SIP. It would have given you 3.83 crores. And a multi cap fund which is done reasonably well, a 9,000 rupee SIP would have given you 2.69 crore. So instead of you just picking one fund, if you had invested 3,000 rupees in each of these three funds with 271 months, your portfolio would have looked like this: 2.77 crores worth of CAGR of 18.19% for during little more than these 20 years. So the first part, what I told you, important driver is asset allocation. Second, the most important takeaway, what I want to give you is selecting right set of funds is very, very important. If you have very high skewed small cap portfolio, sectoral portfolio, the risk involved would be significantly high. So select right set of funds in the portfolio, and also don't expect or don't put all your burden of performance on one scheme. Try to have basket of funds. Okay, that's what ideally you should be looking for. This is the second step. But it is not just about selecting equity funds. It's also important how do you select debt funds. What kind of debt funds you select? See, there are 4 economic cycles, right? Early, mid, late, and recession. So when we say we are talking about economic cycles, the early phase is basically after 2020 June July phase, where we started recovering from the recession, and then mid we saw a good amount of recovery of economy. Then the late, that means when the economic recovery is peaking, and then recession is when the economy is going down. So this economic cycle is something which is very common. This is bound to be there, right? So what generally happens in very simple terms, if you divide the entire universe of bonds which are there, you can put them in high yield bonds and investment grade bonds. Investment grade bonds are AAA, government bonds, all are high yield, investment grade bonds. High yield are low credit rated bonds. So the learning or the takeaway from in the last 6 decades, from 1950 to 2010, the research by one of the leading asset management companies says every time economy is in the early phase or the mid recovery phase, your high yield bonds does really well. That means bonds with lower credit rating, corporate bonds, or any debt mutual fund which has invested money towards corporate bonds with a lower credit rating would have done really well in 2 phases of economy, that is early and mid. But the moment it goes towards late and recessionary phase, investment grade bonds, that is AAA rated bonds and government bonds, does really well. So ideally, that's how like let's say the allocation should look like. If you see in the current market conditions, when interest rates are expected to go up, then probably your orientation should be more towards short-term debt funds. When I say short-term debt funds, I'm not talking about the category. I'm talking about any fund which is holding, or the average maturity is 1 year or maybe less than 1 year. Floating rate funds. These are the kind of funds which really suits this kind of a scenario, because when interest rates are going up, the thumb rule says the bond prices go down. That means there is significantly high market risk involved for medium term and long term debt mutual fund schemes. Okay, that's the second factor. And third and the most important factor is systematic investment. So you must be thinking, systematic investments is all we know. I mean, I don't think we need a separate session on systematic investments. But systematic investments, I think we limit it to systematic investment plans. But there could be other strategies what we could always consider in the overall investment journey to balance out times or scenarios like this. Okay. SIPs are household name. I'm sure I don't have to tell all of you what is SIP, what are the benefits of SIP, right? All of you would have seen examples. 3,000 rupee SIP invested per month for 30 years at the rate of 12%, you would become a crorepati. Many such examples. Would you believe all of them? Would you believe that with 3,000 rupees you could become a crorepati? We generally don't believe them, right? Because why we don't really believe is you don't really get to meet people who would say that I've made crores of rupees in mutual funds. Why? If you look at AMFI data, that is Association of Mutual Funds in India, their data suggests that after 2 years, almost 50% of the investors withdraw their money. Right? So that means Even though there are mutual fund schemes which should have done exceptionally well, that means the scheme returns are great in long run, you have very, very less number of investor examples would have seen through the journey. So that is why SIP is a very compelling scenario to say that, okay, I will stay invested for a longer period of time. But most importantly, do your SIPs link it to the goals? Now, my question is, would you be happy if your income remains same for next 10 years? You'll not be, right? Every year, you set a hard target that your income should go up by certain percentage. If your company does not give you a raise consistently for 2 years, probably you would have quit that company. You would move on to next company with a better salary. At the time of negotiation, you say, I need salary correction. So I personally think the same logic should be applied for your investments as well. You should not settle with one SIP amount. This is what we call it as step up SIP. So what is step up SIP? Suppose you start with 5,000 rupee SIP this year, 5,000 rupees per month. Next year, you should aim to increase it. That means next year, at least it should be 5,500. Year 3, it should be 5,000, like let's or 6,050 or whatever. So every year you should keep on increasing your investments, maybe 10% or 15% from the previous year. What is the benefit when you do that? The biggest benefit is here. Okay, let's look at this example. It needs a little bit of explanation here. Imagine 5,000 rupee SIP. That means every month you started investing 5,000 rupees per month for 20 years. Okay. For 20 years, if you did that at the rate of 12%, you would have got almost 50 lakh rupees. Okay. But if you increased your SIP amount by 10% every year, okay, I'm not saying you have 10% every month. First year, 5,000. Second year, 5,500. Likewise, every year, if you just increase it by 10%, I don't think which is too difficult. You would almost get 1 crore in hand. At 15% increase, at the end of 10 years, you will have 1.5 crore. The difference could be 2 to 3x if your portfolio gave you 12% return. Right? I mean, you could be conservative and then say, my portfolio, my expectation is only 10%. That 2x might just become, say, 1.5x or 1.6x, but it is still better than 1x, right? Same logic of 30 years, 5,000 rupees per month for 30 years would give you 1.76 crores. But if 10% increase would give you 4.41 crores. So now this is more than 2x because the time horizon is longer. At 15% increase, you almost get 8.5 crores. So that's the kind of money or the wealth what you can make with step up SIP. Right? So that's about systematic plans. In all the examples what we take, we assume 12% return every year. That means what? Every year you keep getting 12% return. But is that how market is good function? No, right? If you've been in investors in the last 5-7 years, you would know 2018 and 19 were relatively disappointing years for investors in equity market. 2020-21 were great years, but 2022 is looking very disappointing all over again. So many people would say by 2020 beginning would have started feeling disappointed that my 3-4 years SIP or my 4-5 years SIP is actually not doing so well. What should I do? Should I redeem? Should I withdraw? What I want to tell you is a small illustration or an example of an actual scheme, right? If you look at any fund performance or any market performance, it is not symmetrical. It's not that every year you get the 12%. The example what you see is an NAV of a flexi cap fund. It was almost 10 rupees in 1995 January. It went down to almost 5 rupees in 97. And at 99, it was 10 rupees. That means for almost 10 years, 10 rupee became 5 and then back to 10. But then in just that 1 year, that is 99 to 2000, it went up to 25. Okay. So the 10 rupee became 25 rupees in 5 years. But for that 25 to happen, it took only 1 year. So as a smart investor, you might be thinking, Arey, then why should I be part of this fund for 4 years? I'll just be part of that fund only for 5th year. That's not possible because I don't think anyone can time the market so perfectly. So it's very important for us to stay invested for a longer period of time. 3, 4, or 5 years of underperformance can be made up by one good year. That's what happened in 2020-21. Another example, 2010 to 2014, if you see, there is another fund, the NAV of the fund was about 400, 410, went up to 560, down to 360 for almost 4 years. That is from 2010 to 2014, it was in the range of 360 to 510, in that range. But in that just 1 year, that is 14 to 15, it went up to 860 rupees. So it's always important for you to really keep in mind markets like this are bound to be there. Like 2022 kind of scenario is bound to be there. Not every year you will get symmetric returns, and 1 year good performance will make up for all the subsequent previous years losses. Okay, investing in lump sum. Should you invest in lump sum? Yes, you should invest in lump sum. But the biggest risk is, suppose if you have 20 lakh rupees, you put in that money and market crashes further from here. What will happen? It will really eat away into your overall portfolio return, right? What if market crashes is the biggest worry for a lump sum investor. What should you do? I've taken example of, again, January 2008. Why 2008? It's not like it's my favorite example, but we get that 10, 12 years of history. That's why we keep going back to 2008 example. So 2008 markets were at peak. If I had invested 1 lakh rupees, by the end of February 2022, that would have become 4.42 lakhs. That means in about 14, 15 years, 4.5 times, which is not that bad. Okay, and you would have got a CAGR of 11%. It's still good, right? But the challenge is you invested, the markets are at peak, January 2008, markets went down, then again came back up. But had you invested at the bottom of the market, that is in December 2008, had you invested 1 lakh rupees, by same February 2022, this 1 lakh would have become almost 9.98 lakhs, 10 lakhs. That means almost 10 times. It's little more than double with a CAGR of 19%. So look at the kind of difference in wealth if you had invested at the peak of the market or if you had invested at the bottom of the market. So then what's the solution to this? The solution to this could be STP, Systematic Transfer Plan. In the same fund, okay, I've taken an example of same fund, that 1 lakh rupee what you wanted to invest, instead of investing all 1 lakh at once, if you had invested 10,000 rupees every month for 10 months, right? So every month 10 months, the advantage is every month NAV is going down, no problem, markets are coming down, but the number of units you purchase is actually going up. You're getting at the end of February 2022 that 1 lakh rupee would have, what you've invested is worth 6 lakh rupees. That means it really gotten better compared to investing at the market peak, right? So that's one of the biggest advantage of systematic transfer plan. There's always that constant debate, right? I mean, lump sum versus SIP, which one is better, right? Mathematically speaking, lump sum is always better than SIP, right? Imagine somebody investing 20 lakhs today or 50 lakh rupees today, waited for 10 years. Let's say markets went up from today, you would have got great return, right? But SIP, every month you're just investing smaller sums of money or whatever sum of money, waited for 10 years, the returns would definitely, or the money what you would have accumulated would definitely be not as high as lump sum. The question is, how many times you have this lump sum money all the time? The logic I give, or the analogy what I give is, if you're a batsman, it could be T20 game or a one-day game. Our ambition, okay, every batsman ambition is to hit for a six or a boundary in every ball. Is that possible? No. You need to respect the bowler as well. Bowler is also very talented. When a good ball is thrown at you, instead of trying for a six or a boundary and then getting out, probably respect that ball, take a single, one or two, and then whenever you see a loose ball, hit it for a six, right? So there is no harm in getting those 1 or 2 runs, build your innings, and then you see a loose ball, you hit it for a 4 or 6. So what I'm just trying to say is, don't make it lump sum versus SIP. At the end of the day, some kind of a corpus should be your end goal. SIP and lump sum would actually help. Both these would help you in terms of getting to that particular corpus. Not every month we would have money. SIPs brings in discipline in our investment. Markets like this, even if you don't have money, SIP is running, you would have units getting accumulated. That's the benefit what you get. Lump sum, boosts your corpus. That's one of the advantage of Lum-sum. So both are good. Don't try to really choose between the two. Okay, and the last point with respect to like I said, managing the portfolio from systematic way is like let's say, when should you redeem money from equity? I love this example. Imagine yourself traveling on a nice 6-lane highway. Okay, for the sake of example, we'll take example of say Bangalore to Hubli. It's a good 6-lane highway. You're driving, so now you need to get off at Davangere. Right, Davangere is a bypass, and you're driving your own car at 100 120 speed. You're at the right most of the lane. Now you need to take the bypass. You need to take left. Would you take the sudden left and then exit from that particular highway? You might probably survive once, but you may not survive every time. So what is the right and the safer way to exit from your highway? Slow down your car, put the indicator on, keep coming towards left side of the road, come to the extreme left of the lane, and then you take an exit, being very slow, right? That's the safer way to exit from the highway. I personally think equity market is also like a continuous running highway, right? If you wait for that day, acha, you are retiring, or children are going for higher education, or you wanted to buy a house, any goal, any purpose for which you have set aside the money, on that day, if you were to withdraw, what if markets have crashed on that day? You would have lost a good chunk of your accumulation. That's why the right way to exit is probably, like let's say, slowly start doing STP, systematic transfer plan, from equity to a debt fund, or you could also opt for SWP, systematic withdrawal plan, so that you withdraw it over a period of time. So they are also tax efficient as well, right? I mean, that's one strategy what you could actually adopt. Maybe combination of STP and SWP process, or an SWP process based on your financial situation, right? So that's the scenario what you could look at. And some of the myths of investing would be, let's buy NFO because per unit price is only 10 rupees. The new fund or the existing fund, what I'm intending to buy, NAV is 100, 200 rupees. Listen, please understand, NAV as such does not matter. What matters is percentage of it. If a particular fund has a very high NAV, that also means that fund has some history. That fund has some track record. You can always go back and check. Okay. Whereas a new fund, 10 rupee fund, means there's no track record. It's a new fund. Whom would you trust? A doctor who just started practicing, or a doctor with 25 years experience? I'm not saying don't trust the doctor who just started practicing, but you would always want that someone with lots of experience, right? So a higher NAV fund would essentially also mean that a particular fund has experience. Just because a fund is old does not mean that you invest. That gives you an opportunity to understand that particular fund. And considering the current tax regime, growth option would make more sense compared to dividend option, because dividends are taxable in your hands. Whenever dividends are declared, you will have to show it as income from other sources. Whereas in growth option, only when you redeem is when you show it as capital gains. And then based on the type of capital gains you've made, you end up paying taxes, or adjusting for the tax there. Okay. So on that note, I would like to conclude the session. If there are any questions, I'll be more than happy to answer. Any questions? Anybody?
Yes, sir. So there are some questions. Some questions you have already answered, and some slides. So yeah. So there is one question. Like it's saying, how about taking the? It's regarding to that asset classes, the large cap fund which you have mentioned. Regarding to that question, how about taking the worst doing fund and sharing the data to now how the risk played out the large and mid cap multi.
Yeah, Kamal, sorry, I
Yeah,
lost you there. I didn't get the question. Okay, if you can...
Yeah, it's the question regarding to the large different large cap
Okay.
funds which you have mentioned. That's a question regarding to that. So it's saying like, how about taking the worst doing fund and sharing the data to know how the risk played out in the different categories and how much is the CAGR then? Hello, Mr. Karthik, we're not able to hear you. Mr. Karthik?
Uh, well, sorry, I think there was a bad network due to rain.
Yeah.
I guess
Your voice also breaking. You able to hear us?
I can hear you. Yes, can you hear me?
Yeah. So you heard that question? So which we have.
Yeah. How about taking the worst doing funds and sharing the data to know how? No. See. Like the data what I showed you, Kamal. The list of those funds. Only those funds who ever touched top three once in their lifetime. So there are so many funds which is never there in top three or top five rank ever, right? So just by going by the logic of picking the worst possible funds and then being part of them every year may not be a great idea, is what I think, right? Uh, um, I, again, in my personal observation, I could be wrong. If a fund is fairly consistent, sticking to those portfolio funds would have given you better returns than portfolios where you have churned very often. Because there is also an element of cost which is involved. So I personally think churning at regular intervals only solely based on their yearly ranking may not be a great idea.
Yeah. And next question is like, when my financial advisor suggests me a fund, what should I look for?
That's a very tricky question. I think first you should really have a faith in your financial advisor. It's like you really need to have a faith in your doctor. Only then you go to the doctor, right? I think that's the first thing. Have that faith in your financial advisor, but also it's also good. It's always good to really ask a few questions. I think more than looking for, probably you could ask some questions. Why this fund? Why not the other fund? I think some of these questions would really help. But look at some of the ratios, like what is the risk involved in the fund? What are the risk adjusted returns, like Sharp ratio, Trenner ratio? So some of these ratios look very, I mean, we don't really look at them, but I think looking at some of these ratios would always help.
Yes, sir. Thank you. And there is one more question. We cannot time the market. So, what kind of fundamentals the fund should possess to hold on it? It may take 4 to 5 years time to yield, or if it never yields, so we are wasting time holding to that fund. So, how is this decided?
Yeah, I think these are very subjective questions, for how long you would vote. But I think waiting for a fund to perform for 4 or 5 years would be is a lot of time given to that particular fund. I think my personal view is 2 to 3 years is good enough time to really see if it is not really playing out. You could always consider what could be done. But I think 4 5 could be is too much because I think some of the funds never aim to that average or above average performance as well. So yeah, for the average CAGR for.
Yeah. And next question is like, what parameters would you recommend to assess if the current allocation is all right?
Oh, I think the first and primary thing you should be looking at your goal. For how long you would need that money for. If it is really long term, then broadly the portfolio with